Here's a couple of things I want you to talk to. Point number one, you said a second lien at 9.5% to 10% interest. Okay. First of all, let me just ask you a couple of clarification questions. Number one, is what interest rate is the first loan at the same thing?
No, it depends. So what happens is that to keep things, because we got to use underwriters and you got to use an RMLO because you got to, if you understand, we're not going to dig in the weeds. It takes too long, but
But real quick though, what is that? Just so people know
so
what we're talking about.
According to Dodd-Frank came in play several years ago. They said if you're going to do more than 3 or 5 deals a year, depending on where you are or how you interpret the rule, is that you have to use a residential mortgage loan originator, basically. And you either got to have them in-house or you got to hire somebody to do it.
And this is who? What is the RMLO though?
The RMLO basically takes all the borrower information, takes their application, they pull the credit, they build the file, they do all the disclosures and say your payment's going to be this, and they disclose all the documents on behalf of the lender. Okay, that's what they do. Which
in Dodd-Frank in 2000. When was this? 2008, 2012. I think it's
2012. I think it was 12, 13. Yeah.
12. When Barack Obama passed Dodd-Frank, they did it coming out of the mortgage crisis to protect the consumer. And that's the reason this all takes place. So you use that, which allows you to do more than 3 per year or whatever it is. What about the interest rate on the first loan?
So as a small cap lender, which is what we are and what most people would be doing this, is that there's really only really 2 things that that have to be done. One, you have to prove that the borrower has the financial capacity to make the payment. Okay, that's what the RMLA does by taking their financial information and verify who they say they are. That's it. And then the next thing to keep it a qualified mortgage and being conforming is that it has to be written at no more than APR plus 6.5%. And the APR is the average prime offer rate, which is like a LIBOR or it's a government index that they'll use to set the maximum rate allowed to keep it a qualified mortgage. And all that means is like if it's 3%, for example, and you can write that first lien at 3 plus 6.5, which would be 9.5%. That's it. And then
that's the first loan. You'll write it at that.
Yes.
Mm-hmm. Okay. So, and this is where I don't know. I've never heard of that before, where it's 3 or it's APR plus 6. I've never heard of that before. Is that?
Well, let me just say this. I've done this over 1,000 times.
No, I'm just saying I've never heard of it.
No, but that's why we're having these conversations, because I'm glad you brought that up, because you're extremely knowledgeable and sophisticated in the real estate space. Okay. And this is the biggest problem that most investors make when they go create paper. They don't understand. And when you don't know what you don't know. And that's why things such as like understanding what Dodd-Frank is, understanding how to take a borrower application, how to underwrite that file, how to create those notes, how to be able to service those notes, and how to be able to exit out if you choose to do so, is way, way more important than just being able to go find a buyer and say, hey, give me 10% down and I'll sell you the property and carry the note. It's a really, because here's the challenge with this, and this is why I want to bring this up, is that we're in a risky position as an investor, because we're an investor and we're in a company and we're selling it, and we're commercial for a lot of reasons, but we're selling it to an owner occupant, which is an individual. So we already have. We got to be really careful on how we structure things, because we don't want to become a predatory lender. We don't want to look like we're taking advantage of people. And that's why the disclosures are so critical and important. And that's why having all these pieces, and it's not hard to do. They're all available to you to use. You don't have to know any of this. You just need to know that you need to use them.
Here's the second issue I have. Well, The first one wasn't even an issue. It's just a clarification.
Sure.
I guess I have a personal issue with a second mortgage, and you're sitting here talking about no risk. Well, no risk in the sense that you've got your money back, and all money that you receive from there on is infinite return. It's all bonus money, free money, so to speak. Mm-hmm. So I know that's kind of what you were saying when you meant no risk. But as far as I'm concerned, a second lien is risky to me. Talk about why you said. Well, I guess I understand why you set it up that way based on what you've already said.
Right.
But second liens don't scare you.
No, not at all. Because because I still have the asset as collateral on the debt, right? So,
right. But if it were to go to auction, that
okay.
second lien can get wiped
So why
out, can it
can't,
not?
okay, so why can't I cure the first loan if I really wanted to keep the property? I'm only at risk if the property goes down in value and nothing else gets cured first. That means for it to go to auction, okay, first of all, going to auction is extremely, extremely rare, okay, contrary to popular belief, because a lot of things have to happen. First of all, the borrower has to stop performing. Number two, you can offer a deed in lieu, you can offer cash for keys, you can do a forbearance, you can do a loan modification. The buyer would definitely have to want not to be part of the house anymore, okay? So if it's done correctly and there's an equity position in the buyer's in the borrower's favor, which there should be if you do it correctly, is that in this example where I said the $200,000 property, we sold it $20,000 down. So then the note value is 180, 150 is the first, and in this situation, 30 is the second. Well, that would have to, if it goes to foreclosure and it sells for 210, that second lien doesn't get wiped out.
Right.
It only gets wiped out if it goes, let's just say it goes to foreclosure and sells at 170. Okay. So what happens then? If it sells at 170 and you don't want any part of to do with it, well, the first lien holder is going to get their 150. If I'm using these numbers, and obviously they go up and down based on how long the note's been paying legal fees, and you get the balance of it. Right. So it's not like it'd have to go below all of that to get washed out zero. And I've never seen that happen if it's done correctly and the borrower is underwritten correctly. Can it happen? Hell yeah. I mean, there's a lot of things I didn't think were going to happen. Look what happened in the last 2 years. All bets are off. I mean, who knows what's going to happen tomorrow? So, but to your point, those are obviously concerns. And I would say, well, if you're that concerned about that, then just get more down payment. Instead of getting $20,000 down, say, you know what? I'm not going to sell these with less than $25,000 or $30,000 down. And now your investment, the value goes down.
And that's a great, I'm glad you brought that up because that's a great point. And I want to talk to some people who may be watching this or listening to this right now might be asking that question, Nick. Who, if they are a good enough borrower, and I understand that every lending institution is going to have different rules. They're all going to be a little bit different, but if they are a good enough borrower to get a loan, because they're going to have to go through underwriting just like with you, just like with anybody else. If they're a good enough borrower to get a loan, why would they pay you 10% down when they could probably pay a lot less down traditionally? That's number one. And then number two, why would they pay such a high interest rate?
Well,
where are those borrowers?
Yeah, that's a great question. We'll talk about that. First of all, if you're that good of a borrower, then you should go to Wells Fargo or Bank of America and get the loan. But I'm telling you right now, we already talked about this, depending on where your source of data is, 70% of the population can't do that.
Okay. So I think that's the disconnect for me right now, Nick, and for maybe some people who are watching this or listening. Why would they be able to borrow from you and not from a Wells Fargo and a traditional?
Because I'm looking at more on the asset and their financial capacity to make that payment. Okay. That's it.
Which is still within the guidelines of you being able
still looking at the same DTI, still looking at, maybe their credit scores are, 600 instead of 725. Doesn't mean they're not a good borrower. Doesn't mean they don't pay. Maybe they had some other underlying issues in their life that caused them. It was medical. Maybe they haven't had a job for 2 years because they had COVID and they had to change from one career to another. That all resets to a traditional buyer. All right. There's a lot of factors. And if you don't have all of those lined up, maybe they're not a W-2 employee and they work for themselves. Huge deal killer for a bank. Another one that we see a lot of, I'm in Texas and you're in the South, is that we get a lot of international people that come in that have the right to work in the United States, but don't have a social security number, and they have an ITIN number, which is an individual tax ID number, which allows them to pay taxes and work in the United States, but they can't go down to the bank and get a loan. It's stupid. And that's a big part of it. Whether they're Latino, whether they're Australian, Canadian, Indian, it doesn't make a difference. They go work and do whatever that they can't go buy. That's another big big part of the demographics.
Yeah.
So, and it could be cash reserves and things along those lines.
Yeah.
As far as the interest rate, that's a great question. So I always ask this question, and we've done this over 1,000 times now. And it's funny, the first 10 deals that I tried, I almost didn't do this long term, but the first 10 deals that I did, I probably got asked 5 times to go, the interest rate's way too high. Then I figured it out. I go, the question always becomes, well, what's the interest rate on rent? Right? Would you rather make $1,000 a month payment for rent, or would you rather make $1,000 payment to own a property? And if you can keep it in that terms. And rent, there's no return on rent, but at least you can figure out if it is on the mortgage.
And also, if they get their stuff in order, they can always go refinance into a lower rate as well.
100%. Absolutely. They should do that. I would encourage them to do that. And because there's no prepayment penalty to refinance. They can refinance tomorrow. In fact, they just did this. And the other reason why is this: not everybody trusts banks. Let's be honest. Okay. Contrary to popular belief, not everybody trusts the bank. There's a lot of people out there that don't have trust in the banking system. And for whatever reason, they would trust me or you or somebody else to do it. But here's the other advantage of the seller financing model. It's called velocity. Okay. It's the ability to get in and get out of these deals quickly. Because guess what? I could sell you a house today. I could have you in front of the RMLO this afternoon with all the paperwork done. 7 days later, assuming I have clear title, we can be closing on that transaction. You can't even get an appraisal done in 7 days because you don't need an appraisal. You don't need an inspection. That's a borrower's decision if they want all that stuff. But from a lender perspective, it's not critical because I can go do a BPO. I already know what the property's worth. I don't need to have somebody else verify that because we're local to the transaction. I'm not sitting in some high rise in New York City.
It's your transaction.
100%.
You already know the property.
100%. Absolutely. I already know the answer to the question.
Nick, I'm getting a lot out of this, and I hope folks that are watching this are getting a lot out of this.
That's a lot to take in, man. It's because there's no TV shows on this, Brian. Let's be honest. It's easy to understand the fix and flip model or the buy and hold model, right? Because that's what everybody talks about. But here we're talking about and trying to educate somebody in 30 minutes on it's just another thing to think about, right? Doesn't mean you should put all your eggs in the seller financing basket, but nor should you put all your eggs in the fix and flip basket or landlord business or whatever the hell it is. You shouldn't do any and all of those. You should diversify. And that's all I'm trying to share today.